welcome to the Honolulu Hawaii Housing Report. I'm Patrick ONeill, Principal Broker Owner at Luxury Homes International, and with me today, the president of TZ Economics and one of the leading economists here in Hawaii, the very famous Mr. Paul Brewbaker. How are you today, Paul?
Not famous.
Not famous. Auspicious. Today is a palindrome, by the way. It's a palindrome Aloha Friday.
22522. Ah, got it.
All right. So it's a special day, I think.
Madam, I'm Adam.
Yeah. So we have a lot of things to jump into today. And I thought we'd start with sort of inventory, sales velocity, see if there's any relief out there on the horizon for buyers. And we definitely should talk about the economy overall. Inflation, interest rates going to have a big impact. And then finally, let's take a look at pricing and your projections as we're heading into to 2022. So let's start with, I'm going to pull up the Board of Realtors information. So this is the latest data that's been released by the Honolulu Board of Realtors. And let's get all set up here. All right. Okay, so the first thing I thought we'd start with, Paul, are the new listings. Now, this is month over month, and I know not always a real good indicator, but these are pretty big numbers. So this month compared to December, certainly more listings coming on the market. Seemed like a pretty good thing for the buyers. But if we look at new listings compared to last year, January, basically the same for condos, and we're actually down 12% for single family. And then looking at the velocity of pending sales, again, this is month over month, single family homes, almost 10%, condos over 12%. And kind of wrapping it all together, active inventory, virtually unchanged month over month, but this is kind of interesting. This is compared to January of last year, active inventory down substantially in both categories. What do you kind of make of all this?
Well, I mean, you've still got a tight market here in Honolulu, on Oahu, and some of the increase in listings is probably seasonal, which is why, even though it went up a lot from December to January, it's less than the same change a year ago. But of course, at these prices, you would expect that you've got really high prices of 1.05 million on the single family side, over $500,000 on the condo side. So you'd expect that sellers are motivated, continue to be motivated, and the tight inventory is a reflection of the fact that either they haven't been motivated enough, or that buyers, for some reason, have been motivated. And we've seen this in the post-COVID period, right? That some buyers seem to have had a special motivation of changes in their lives and the nature of the work and where it takes place that have accompanied the COVID aftermath of the COVID transition to endemicity, and the likelihood that more and more people will be working at home or will have the opportunity to do so some days a week. So there's been a little bit of that kind of shift driving the demand. What we've got is a bit more of a rebalancing, but at very, very low inventories. I mean,
and I'm going to go to this. I'll go to this next slide, and we can kind of see this is going back to January. The gold representing the condos, the green, the single family homes. If we kind of focus in on it a little bit, here we are.
I mean, just think about listings for a second, right? 1,000 listings, almost 2,000 on the condo side pre-COVID. So 1,000 single family homes, 2,000, 1,800 condos pre-COVID. And now everybody's hoarding, relatively speaking. Only 1,000 condo listings every month, and maybe less than 500, maybe less than 400, as we're seeing right now. But demand continues to be relatively strong. Of course, we're looking into headwinds, right? The Federal Reserve has indicated it will follow through with its intentions to, for liftoff of short-term interest rates next month, and for the asset purchase program, which helped put a lid on longer-term interest rates and mortgage rates. That program will end as of next month as well. So it's a phased process, right? They stop buying assets, they lift off short-term interest rates, and when they're done with lifting off, then they began to allow assets to roll off the balance sheet. So it's a multi-year transition to a more normalized interest rate environment, which means upfront, because investors are forward-looking, that mortgage rates already have risen 50 basis points or half percentage point. And
hold that thought for a moment, because I want to talk more about the interest rates and the inflation and the impact on the economy. Just to wrap up this section. So the month supply of active inventory, putting together sales pace against the inventory, we can see it's virtually unchanged. This is clearly still a very, very strong seller's market. Would you agree?
So far, definitely. We'll see how much the headwind of rising rates matters, but at the moment, there's not much inventory and still plenty of interested buyers.
A lot of sales pace, and then this is the result. Nearly 40% of condos still selling above the list price. Over 60% of single-family homes still selling above the list price, and these are list prices that are up, right? These are up substantially from last year, and still the sales pace and the velocity is strong.
Well, so it's strong till it isn't, but there's no question that pattern you showed of 7 or 8, 6 or 7 months there, very holding steady in terms of purchase price over list price. That's withstood 2 COVID variant waves, the Delta variant and the Omicron variant. So, as far as you can see the impact of the variants in travel statistics, but you just don't see it in the housing market at all.
It's really amazing. I think everyone expected a little bit of a slowdown this January, just because last year was so crazy. And the volume, when we did our year-end recap, the last time we've had volume of those levels was the run-up to the subprime bubble. I know it's totally different moment in time, but that's the only time we've had that kind of volume. Paul, why don't we take a super quick break, come back, let's talk about the economy, inflation, and your thoughts on the interest rate and what's going to happen throughout this year. Okay, so stand by. We'll be right back with economist Paul Brewbaker. All right, and welcome back with economist Paul Brewbaker. And Paul, we're just about to talk about the economy in general, and would love to know your thoughts on inflation. We're hitting 7% this year. I don't know, 6%, 7%. And then also interest rates. What do you see happening this year and its impact on the real estate market?
Well, a little different picture in Hawaii than on the mainland, where the 7.5% measure of inflation has been recorded. And in parts of the country, like the intermountain western states, where there's been a lot of economic growth and migration, Idaho, Utah, Nevada, Arizona, where regional inflation is as high as 9 or 10%. Hawaii's at the low end of the spectrum. We've underperformed. Hawaii's underperformed, both in terms of the pre-COVID as well as the post-COVID environment. So, slower going into the COVID recession, a deeper recession because of travel and tourism, and not as robust a recovery. I mean, we're coming back at about the same rate as the rest of the economy, but coming from the lowest position, we remain at the bottom of relative performance nationwide. When you look at inflation, we measure inflation using the consumer price index primarily. And in the case of Hawaii, it's all we've got, the Urban Hawaii Consumer Price Index. And so I'm showing that here, the actual index. I've rebased it, so I'm going to start in 2018. And then if, let's say you have 2% inflation, then if you start at 100, then the next year you should have an index of 102. You see what I mean? And a year later should be 104, right? If you've got 2% inflation. Well, 2% inflation is the Fed's goal for monetary policy. And it turns out pre-COVID, Hawaii was running at about a 1.6% rate. That's that slope I've drawn in here. And so currently with 6% overall inflation, you've got three elements. You've got the 1.6 or 2 percentage points that are just part of the underlying trend. That's the Fed's goal, is a 2% average inflation target. So we had that. We were pretty much, on or just below that target. And then you've got 2 percentage points that's coming from a more robust economic expansion for a variety of factors, including the fiscal stimuli over the last couple of years, including accommodative monetary policy, low interest rates. And then you've got 2 percentage points that are coming from supply chain disruptions. The fact that the transport of intermediate products for assembly into final goods has been disrupted by the global pandemic, disrupted globally by the pandemic. And so a lot of the demand for goods that's coming from the recovery and from fiscal stimuli, let's say, or say from low interest rates, can't be fulfilled by the suppliers. And so 2% underlying inflation, the goal of the Federal Reserve, plus 2% coming from monetary and fiscal policy accommodation, and another 2 percentage points coming from the supply chain disruptions means you've got 6%, 2 plus 2 plus 2% equals 6% inflation. Now, historically, that's not as big a deal for Hawaii.
Paul, may I ask you a question going back to your previous 2, 2, and 2. So 2% Fed target rate, you've told me for years, 2 is the number and the number is 2.
Number is 2.
So that will kind of always be there at some level. The additional 2, which is stimulus, has come and gone, but we're still there. We still have this 2.
It's like a hangover, right?
It's like a hangover 2.
Yeah.
So that,
but you're right. You're right.
Eventually melts away.
That part is being withdrawn. The monetary policy is moving towards less accommodation, and the fiscal policy stimuli ended a year ago.
So theoretically, that 2 melts away, we'll say, and now there's this other 2, which I'm assuming now you're going to say is transitory because that's supply chain related.
Transitory, but taking a lot longer than we thought to self-correct. And here's the problem. You can't use monetary policy to fix the semiconductor supply chain that's got automobile manufacturing disrupted. Indeed, even though we were waiting for both the supply chain and the so-called aggregate demand, fiscal and monetary policy induced inflation to abate on their own, it's been a year. It's like, okay, let's stop waiting and do something about it. And the problem is now that monetary policymakers are going to do something about it, it doesn't work right away. You see what I mean? And you have to be careful not to slam on the brakes and cause a car crash. You want to sort of, gently decelerate the forward momentum. Ideally, what you would see is that slope in this graph would just shift upward and connect to the last dot. So we'd go back to the 2% trend, and the impulse from these extraordinary post-COVID factors, would melt away. It's just it's not happening as fast.
I see.
And the risk is that if people get into their heads that it's not going to go away, that the policymakers will not succeed, they'll start betting that it won't succeed. They'll start asking for higher wages than is justified by their productivity growth. They'll start speculating in asset classes like housing or commodities or Bitcoin, where they think they'll find some shelter from the inflation that they no longer believe governments can manage. And we live in an era of distrust and misinformation that is contributing to that. So, and unfortunately, even in the legitimate media where there are some standards of ethical behavior, you hear this kind of headline, highest inflation in 40 years. Well, somewhere that's true, but not in Hawaii. And here's 80 years of data. So not only is our inflation in Hawaii not the highest in 40 years, it's only as high as it was in the subprime bubble, which you referred to a second ago. And it has none of the attributes, which was lower than the previous Japan bubble, which in turn was lower than the 70s. And none of the attributes of those previous inflationary periods where you had this long crescendo, 5, 10, or 15 years of mounting inflation, punctuated by supply shocks like the OPEC crisis.
And it looks like all these peaks on your chart here, Japan bubble, subprime bubble,
yeah,
there's a fast correction. I mean, in relative
well,
terms.
when the correction came, it came in the form of a recession, and it was kind of the crash and burn we're trying to avoid. And so in the current moment, where the inflation looks more like a light switch in the historical context, where something bizarre happened, like, say, a pandemic, and you know, that's probably over, or we're probably transitioning away from the pandemic moment to living with an endemic coronavirus, where the light switch in principle could be turned off. So the trick here is to sort of nudge it in that direction. But of course, lately we have, you know, like Rosanna Dana said. Is anybody listening old enough to remember Rosanna Dana?
I do, Rosanna Dana.
You know, it's like my grandmother said, if there's not one thing, it's another, you know. And so here's the price of oil in dog years in constant $21 per barrel on the left side of the screen. And then I've segregated, I've decomposed those price movements in oil prices into a long cycle and a long trend, and then a noise component. And in the bottom right, you'll see how much noise we've had in the last 2 or 3 years. We've gone from pre-COVID, where things were normal and oil was $80 a barrel, to the COVID moment where oil fell to $20 a barrel. And now we've got the invasion of Ukraine pushing oil towards $100 a barrel. And, you know, the right number is probably, I don't know, $60 to $80 a barrel. But when you get down to 20 and then you go up to 100 or 120, let's say, and then we'll see in the next few weeks, that kind of volatility makes people a little crazy, and you worry about their faith or confidence in the low inflation environment, which we've actually enjoyed for the last decade or a few. We worry about them losing their confidence in the ability to return from that to that, and engaging in, say, investment behavior that is that actually contributes to an inflationary outcome, like bidding up the prices of housing.
So we were talking about this earlier. So it's not necessarily that the populace are looking at all the economic data and figuring out, you know, where the number is. It's just simply they see assets going up so fast. Bitcoin is an example, or maybe in a speculative real estate bubble, everybody's just jumping on, or the price of oil.
Yeah. So
you're jumping on with the expectation it's going to be higher tomorrow, and I want in now.
You know, and leadership matters. I mean, we respect Jay Powell. We respected Janet Yellen. She's Treasury Secretary now. And there was something about Ben Bernanke at the moment in the financial crisis of 2008, 2009, and the team he had, Tim Geithner and Hank Paulson at the Treasury before Tim Geithner went over. So there was a team of people in which financial markets, and I think the population generally, had confidence that independently could get the job done and would not be subjected to political influences. And I think some of that's been eroded. You know, there's concern about the appointees to the Federal Reserve Board, not just in the current administration, but from the past one. And I think at this point, I think Congress has held up those appointments. Anyway, my point is leadership matters, particularly when you're facing crisis conditions. And so I personally would like to encourage people to have faith that the people at the Fed know what they're doing, that their independence is important, that they should not be a political instrument of Congress's administration. And that I think you can reliably count on their own projection for interest rates over the next year or two, which I'm showing here. This is from the December forecast. They published their forecast. You don't need my forecast, because you can get Jay Powell's. And they will revise that when they meet next month. We'll get an update. It's going to be a little steeper, because I think, you know, the Fed has, like the rest of us, have been surprised by the durability and intensity of the post-COVID inflation moment. It's been more and lasted longer than we thought it would or should, given that We believe at least a portion of it is transitory. So, it's reasonable to expect that they could move faster than they were thinking a few months ago. But I wouldn't expect anything significantly different from what they've already laid out in quite a bit of detail.
So we're talking about interest rates. So
yes,
we've all expected, and the Fed's been saying without saying, or saying and saying, it's going to go up 1 basis point at least over the next 12. Well, starting over the last quarter for the next 12 months, something like that, right? 1 basis point. So if we're looking at what they're projecting, to use an easy number, let's just say interest rates today are 4%.
Well, where do you think? Let's use the actual numbers. So the overnight rate today is a range of 0 to 0.25%, and the long-term equilibrium that the Fed believes is relevant is something around 2.25% to 2.5%, maybe a 2.33%. So we've got 2 percentage points, 1 percentage point this year, another percentage point next year, something like that. We've got 2 percentage points of increase in the overnight rate to get from where we are and where we've been for a couple of years because of COVID to where the Fed itself believes the long-term equilibrium trajectory resides. Now, that's the overnight rate, but mortgages are long-term commitments, and they arbitrage to longer-term yields, like the yield on the 10-year Treasury note, 7, 10, the 30-year yield. And those are right now already about 2%. That is, the longer-term yields anticipating and being informed by the Fed what short-term interest rates are going to do, because long-term interest rates are just a sequence of short-term interest rates for a long time.
Right.
They've already moved very close to the zone where we end up. If anything, there's maybe 1/4 or 1/2 percentage points of interest rate movement left at the long run. And of course, a part of what you worry about is a risk premium that comes from uncertainty about inflation itself, and inflation risk premium. But that turns out to have remained relatively small. And I think it's durably so, up to the concern I expressed earlier about people losing confidence in leadership and monetary policy. So we're kind of the 1/2 percentage point increase in mortgage rates. We've already seen much.
Right. So we went. Now we're talking about mortgage rates for homes were 3.5 months ago. Now they're probably getting close to 4. Or they're going to be right at 4.
Yeah.
A year from now, 12 months from now, you think it would be what?
Well, let's say the long-term overnight risk-free rate was 2.25%, and historically the average mortgage has priced to that benchmark by 175 basis points. 1.75%, 2.25% plus 1.75 is 4%. So we're already kind of approaching or in the zone. If the overnight or equilibrium risk-free interest rate is closer to 2.5% than 2.25%, then the equilibrium mortgage rate would be around 4.25%. But I don't think we're talking about 5%.
I see.
And unfortunately, if you're looking for 3%, you probably missed the moment.
You probably missed it, right? And
for now,
to keep it all in perspective, this is still historically low rates. These are still historically low rates.
It's still a bargain, and it's all down to something we'll come back to after the break, which is this idea that even if people aren't aware of it, inflation in the backdrop is contributing to their perception of what a proper rate of return should be in asset classes like housing versus bonds, because you can live in a house and protect yourself from inflation, but you can't live in a bond, the value of which inflation will erode.
That's true. Okay. Well, on that note, let's take a quick break. We come back, we will talk about home prices and where you think they're headed. So don't go away. We'll be right back with economist Paul Brewbaker. Okay, and we're back with economist Paul Brewbaker. And Paul, we're just about to talk about housing prices and your projections for the future. So let me pull up the statistics again from the Honolulu Board of Realtors. And we're looking here at the median price. This is the third month in a row, month over month. Single family hasn't moved. It's been at this 1050 for the last 3 months, no change at all. Condos up 5% over last month, actually hit an all-time high of 510,000. What do you make of this so far with the pricing? Where do you think things are heading?
Well, it's up there, of course, but that's not unusual. I mean, Oahu's a desirable housing market, and Honolulu prices are always up there. You know, not quite in the neighborhood of Santa Clara County, California, or say San Francisco itself, but definitely in the neighborhood of Orange County down in the south, and a lot of the California coastal metro markets. That's kind of Honolulu's benchmark. And what we're seeing here is not that much different from what you see in some of those places, although the dynamics are different, right? They're people in the Bay Area, for example, that are more likely than people on Oahu are to be able to work remotely because of the nature of their industries and occupations. And nevertheless, home prices remain robust up there as well. So for now, I think we're going to continue to see more of this. I thought it would peter out a little bit. There were some indications last summer that we get away from it, but when I seasonally adjust the data, I know the way they're published, they're flat over the last several months for single family, and that there's a record on the condo side. When you seasonally adjust the data, this adds another element of uncertainty, because did you get the seasonal adjustment correct? But you can see that both time series here, I apologize for the crudeness of the image here, but through January of 2022, both time series, both price movements, appreciation movements remain relatively robust. It doesn't seem to be petering out. It's definitely an acceleration, right? These are price movements that are happening at higher rates, faster rates of increase than the pre-COVID, right? This is all pre-COVID up until this moment right here in 2020. And then they sort of explode. So you have to imagine that they can't remain explosive forever. But on the other hand, whatever drove that after COVID, and it's a little bit of a mystery, why would the COVID disruption to the workplace, the disruption to the supply chain, why would that result in houses being not just a refuge, but, you know, an opportunity to go pimp out a home office and start a TikTok video? Or, I mean, I don't know what people are doing, but they're doing things differently from whatever they were doing before COVID, and it's showing up in these home prices, and it may not be over. I mean, it surprised me, and I would imagine, having thought it would lose its own energy. I mean, lose energy by its own sort of, you know, dead weight. I mean, 1.1 million or 1.1 million, that's not unfair, but it's a little bit of a stretch. Even to some of us who've paid attention to these prices over time, I don't get the same bubblicious forces at work that we saw in the 80s with the offshore investor cohort and the legacy of high inflation still fresh in people's memories. I don't see the impetus from the second home buying, subprime, sort of early 2000s wave of, .com refugees and sort of boomers.
I'm glad you brought that up, because I want to show you a slide and have a conversation about this. So, and you and I did this in 2019, the last time we got together live. We talked about this. But so I went back and took the two cycles, Japanese bubble period and the subprime, and laid it against where we are here today. And let me just pull this up real quick. Get your comments on this. Okay, so here we go. So we're looking at the trough through the peak, the cycle we went through, and then the percentage change. And you can see we're in the longest expansion. I mean, it's been 12 years in this current cycle.
Right.
And I know 2019, we started to see some deterioration, but it sort of continued. But compared to the other cycles, which were shorter, we really haven't had that big of a price change, that big run up. What does this mean? Does it mean anything, or what do you see here?
First of all, let me, it's important to think about what the benchmark is. Like, what's the long run equilibrium to which, right, in the long run you're dead, but also in the long run, yeah, it turns out it's about 4%, 4.5%. It's maybe 2.2%, 2.1%. Once you adjust for inflation, if you want to take the inflation out of the picture, and inflation back in these previous valuation cycles was higher, but when you take the inflation route out, the trend underlying all of these movements, going back to the 1950s for Honolulu, and your mileage may vary and history changes and this and that, but for my life, it's been about 2%, a little more than that per annum after adjustment for inflation. Now, when you have the high inflation periods that you're looking at in the 80s and the early 2000s real estate bubbles, sure, the background of higher inflation is being manifested in these rapid rates of home price increase. Because as we talked about earlier, houses are real. They are protection from inflation in some sense. And so as an asset class, moving towards real assets, houses, commodities, maybe we'll see Bitcoin at some point become one of these things, but can provide, at least temporarily, some inflation protection. What was so distinctive?
Paul, let me ask you a question just so that I understand, because I've not heard this before. You're saying the long-term trend line adjusted for inflation is actually 2%. So in other words, 2% plus whatever those inflation rates are, that would be the long-term trend line for home prices.
Which is 4%. 2 plus 2 is 4, right? Two is, turns out, 2 is also the long-run inflation.
Yeah.
Well, I showed you 80 years of data, and it turns out the average there is in the earlier post-World War II era, it was closer to 3 or 4 percentage points per year. But for the last 30 years, it's been closer to 2 percentage points. And actually, what I've seen in these longer-term data sets is that 2% is right. It's not an accident that the Federal Reserve and the central banks around the world have chosen 2% as their inflation goal. It's partly technical because you don't want an actual zero goal, because zero means an average of positive and negative inflation deflation tends to be more disruptive than inflation in the neighborhood of zero. So you move it up a little bit, not 1 percentage points, but 2, because there's a bias in the way we measure inflation that's maybe a percentage point. So it's okay, technical stuff. But that 2%, it turns out, is pretty close to the long run number. And then the 2% real appreciation of, say, houses is very close to the long run productivity growth rate, or proxy for the long run return on capital. So all we're saying is that the appreciation of homes is rewarding you for a number that's not unlike the long-term real return on capital. Now, the capital gain is different from the dividend, which in a house means you get to live in the house. So the total return, right, is going to be the 2 percentage points of inflation compensation, the 2 percentage points of real appreciation, and then the value to you of it's essentially the value of renting the house back to yourself. Mm-hmm. But because we've lived in a lower inflation environment in the last decade, these numbers that we're looking at from 2009, but they're certainly from 2009 to 2019 pre-COVID, which was not 6 but 4% inflation appreciation on an annual average basis. Those are actually consistent with the prior longer, in the longer run, these are cycles of large amplitude. They're big waves of valuation cycles, but it turns out that they're waves around that trend. And we kind of go back right after the big buildup in the 80s. There's a pullback of about 20 percentage points in the 90s. And after the big buildup through 2006, I think, is the actual peak, not 2007. 2007 was when the economy peaked. But between 2006 or 7 and 2009 and 10, prices did backtrack, right? You show it right there from 650 to 575. So, yeah, I mean, that's, we have a choice. We can live on the roller coaster with high inflation and booms and busts, or we can live on on an escalator where things appreciate and or inflate smoothly over time. And then the advantage of the smooth path, the one the Fed's been trying to get us on ever since Paul Volcker, and it takes 30, 40 years to get on the smooth path, but we've been on it. The advantage of the smooth path is then once something wacky happens, like somebody decides to invade a neighboring country, or somebody decides that, they're going to spread a disease around the world. I mean, things happen, right? Geopolitical risk, biological risk, geophysical, an island blows up in Tonga. What? When those things happen, they can be distinguished as outlier events from what's happening in the backdrop, which is modest appreciation of real assets, modest inflation in the monetary system.
Using your analogy of the escalator, so we're on a long, slow, upward moving escalator. We're not on the roller coaster.
Well, we're lucky, right? We've had a big.
We had a little bit of a roller coaster last year.
Yeah, we got
a little bit of a roller coaster.
Yeah.
But would we then expect do we still expect there will be a recovery at some point, and that also would be just more of a moderate kind of an escalator going down?
So we don't know, right? So we're cruising on the escalator of the 20 teens, the longest expansion, not just in American history, as we know, the longest economic expansion in history. And then COVID comes. And it's like, it's that I'm thinking of one of those, anyway, we got flipped up, like hitting the speed table on the Poly Highway and not realizing you're supposed to slow down. Boom. And the question is, are we going back to the old path where we just go boink and then fall back? Or is it one of these things where something permanently changed in the economy, and the path is the same before and after, except for that thing that changed? And one of those things could be, we can all work at home if we have the right skills. And maybe a quarter of the workforce can do that, in which case we need a home to work in, not an office to work in. So that, I don't know. Is it one of these things, or is it one of these things?
Am I overly simple in saying this? And it's always seemed that this was the case. All through my 30 plus years, I don't want to say how long in reality it's been, markets went up when everybody thought they wouldn't go up. Markets went down, everybody thought they wouldn't go down. But the one thing that was constant is markets always went up and markets always went down to some level. There's never been it's never gone down market, right?
Well, no, we can have down markets, right? I mean, we just have been lucky not to have had to experience one of those. But I mean, Hawaii in the 19th century was depopulated by infectious disease in a manner that surely reduced the value of the real estate while it was
but looking at this cycle we're in now,
yeah.
Is it oversimplified, or is it just, if you look back in history, there's always a correction off of however you went up? Does that make sense?
I mean, not if. So here's the way to think about it. Behind you right now, Patrick, the wonderful image of a part of Waimanalo close to the beach. And so right over your shoulder, there's a house right there, and right over your left shoulder, there's a house right there. And there's somebody who lives, she lives in this house, or she lives in that house. And her life before COVID was, every morning she would get in her car, drive over to Poly, and go to work downtown. Or every morning she would walk over to the highway and catch the number 57 bus and go all the way to work downtown.
Not if she's living in these houses, she's not.
Well, not in the houses on one side, but on the other side could have been.
Maybe.
I'm just saying.
Right.
Yeah, she grew up in the house, now there's three generations.
I understand. Yes.
Okay, I'm saying now, she does not know, she no longer has to go to work if she has the skill set that allows her to work remotely. And as a consequence of her having seen this permanent change in the way she thinks about and where she works, could have resulted in a one-time, right, where we don't know yet if this is a blip or like an L-shaped step that's taking a couple of years to unfold.
Gotcha.
The longer it goes on and the more resilient it appears to be, ironically, to me, the less bubblicious it looks to me.
So 2 years from now, Paul Brewbaker's magic crystal ball, prices are still on this slow escalator up. It's leveled off. It's
well, they go
down.
back, right? I'm thinking at some point they go back. I'm thinking at some point everybody has found the house that they need for the world that they now inhabit. It's different from the world they inhabited 2 years ago in February 2020, when, like a miracle, the coronavirus did not go away by April. And as was predicted by certain presidents. And so now that we're in the new world and we're coming out of our caves and some people are abandoning their masks, we will find out. I mean, I wish I could be more, wish I could predict more conclusively than that. But remember, it's not just housing. It's the entire restaurant industry just changed. The entire retail, Safeway woke up and realized, there's another part of the screen behind you that's not visible, but realized that it has 3 supermarkets in the Kailua zip code, 96734, one in Enchanted Lakes, one in Kailua Town, and one in Aikahi. And it probably doesn't need 3. It probably didn't before COVID, but people just aren't going to the store as much or for as long. And like, I don't even go into Target anymore. I just go on my phone and buy stuff and drive by Target and they put it in my car. So a lot of things have changed, not just in the residential utilization of residential productive capacity, but also on the commercial side where office utilization, retail utilization, and so on. Lodging, there's another thing going on in the picture behind you there. The nature of lodging has changed, and we're struggling to figure that out as a community. Yep, whether we admit it into neighborhoods which customarily did not have that kind of exposure, or whether the nature of travel is so different because these are people who are actually going to work for 2 months in a house a month.
Yeah. Well, Paul, thank you so much. It's always such a pleasure having this time with you and getting your insights on everything. Can't wait till next month. And for everyone out there listening, hope you enjoyed it. Please consider giving us a thumbs up down below, right, Paul? You like that? Or subscribe to the channel. That would be great. So everybody, stay safe, be well, and we'll see you back here next month. Aloha Friday.
Aloha, Patrick.